The questions that we seek answers to are look for answers to these questions. What is the present value? How can we use it to compare sums of money from different times? Why are people risk averse? How can risk averse people use insurance and diversification to manage risk? What determines the value of an asset? What is the efficient market hypothesis? Why is beating the market impossible? Introduction of the financial system. The function of the financial system is to coordinate savings and investment. And the participants in the financial system make decisions regarding the allocation of resources over time and the handling of risk. Finance is a study of such decision making. Present value, the time value of money. The present value of a future sum is the amount that would be needed today to yield that future sum at prevailing interest rate. The future value of a sum is the amount the sum will be worth at a given future date when allowed to earn interest at the prevailing rate. An example, a simple deposit. If you deposit $100 in the bank at 5%, what is the future value of the amount? Well, present value is the $100. The interest rate is 5%. You plug that into the formula. After 3 years, you will have $115.76. After 2 years, you will have $110.25. After 1 year, you will have $105. So present value formula is very useful in this regard. Future value formula. Okay. Suppose interest is 6%. Should General Motors spend $100 million to build a factory that will yield $200 million in 10 years? The solution, we need to find the present value of that $200 million in 10 years. And the present value, using the present value formula, yields $112 million. If you're asked to spend $100 million for an investment that is worth $112 million, I think that's a good deal. Since the present value is greater than the cost of the factory, GM should build it. Instead, suppose interest rate is 9%, then that's a different issue. So General Motors spend $100 million to build a factory that will yield 210 in 10 years. Well, the present value of $200 using the present value formula is $84 million. And they're asking you to pay $100 million for an investment that is, you should be paying $84 million. I don't think so. So the present value, since the present value is less than the cost of the factory, GM should not build it. Present value helps explain why investment falls when interest rate rises. Another example, active learning, you are thinking of buying a 6-acre lot for $70,000. The lot will be worth $100,000 in 5 years. They're asking you to pay 70 now. Well, should you buy it? Should you buy this lot at 5%? Should you buy it at 10%? Let's do the numbers. At 5%, you should buy the lot because the present value of $100,000 is 78. If you were to pay a fair price, you should pay 78,350, but you are asked to pay 70,000. So this is a good deal. Go for it. Yes, buy it. Number B, at 10%, it's not a good deal because the present value is 62,090 and they're asking you to pay 70. No, you should say no. Compounding. Compounding is the accumulation of a sum of money where the interest rate earned on the sum earns additional interest. Because of compounding, small differences in interest rate lead to big differences over time. For example, you buy $1,000 worth of Microsoft stock, hold for 30 years, If the rate of return is 8%, the future value will be 10,063. If the rate of return is 10%, future value will be 17,450. Thus, a 2% increase in the rate of return leads to over $7,000 of additional interest and over the 30 years. The rule of 70. If a variable grows at a rate of X% per year, that variable will double in about 70 divided by X years. For example, if interest rate is 5%, a deposit will double in 14 years. That is 70 divided by 5. If interest rate is 7%, a deposit will double in 10 years. That is 70 divided by 7. Risk aversion. Most people are risk averse. They dislike uncertainty. Example, if you are offered the following gamble, toss a fair coin. If heads, you win 1,000. If tails, you lose 1,000. Should you take this gamble? If you are risk averse, the pain of losing 1,000 would exceed the pleasure of winning 1,000. Since both outcomes are equally likely, you should not take this gamble. So here's a utility function. Utility is a subjective measure of well-being that depends on wealth. Okay? The wealthier you get, the happier you are. What utility is telling you is that satisfaction diminishes over time. As wealth rises, the curve becomes flatter due to diminishing marginal utility. The more wealth a person has, the less extra utility he would get from an extra dollar. So here, in this example, because of diminishing marginal utility, a $10 loss, if you lose the gamble that you have to pay $1,000, that loss reduces utility by more than $1,000 gain. So if you look at this graph, if you move to the left, you are losing $1,000, and look at the corresponding loss in utility, large. If you move to the right, you are gaining $1,000, and look at the gain in utility. The gain in utility is smaller than the loss in utility. People are risk averse. Well, how do we manage risk? Managing risk with insurance. How insurance works. A person facing a risk pays a fee to the insurance company, which in return accepts part of or all the risk. Insurance allows risks to be pooled and can make risk averse people better off. For example, it is easier for 10,000 people to each bear 1/10,000th of the risk of a house burning down than for one person to bear entire risk alone. Two problems in insurance market. One is adverse selection, two is moral hazard. Adverse selection, a high risk person benefits more from insurance, so is more likely to purchase it. So the insurance is faced with choosing from a pool that is already risky. A moral hazard is a situation where people with insurance have less incentive to avoid risky behavior. So insurance companies cannot fully guard against these problems, so they must charge higher prices. As a result, low risk people sometimes forego insurance and lose the benefits of risk pooling because the cost is high. Active learning 2. Adverse selection or moral hazard. Identify whether each of the following is an example of adverse selection or moral hazard. Number A, Joe begins smoking in bed after buying fire insurance. Number B, both of Susan's parents lost their teeth to gum disease, so Susan buys dental insurance. Number C, when Gertrude parks her Corvette convertible, she doesn't bother putting the top up because her insurance covers theft of any items left in the car. Answers: Joe smoking in bed, that's a moral hazard. Susan's case, that is adverse selection. And Gertrude, that is a moral hazard. Measuring risk. Standard deviation, a statistic that measures a variable's volatility, how likely it is to fluctuate, used to measure the risk of an asset. The higher the standard deviation of an asset's return, the greater the risk. Reducing risk through diversification. Diversification reduces risk by replacing a single risk with a large number of small unrelated risks. A diversified portfolio of assets whose returns are not strongly related. Some assets will realize high returns, others low returns. The high and low, the high and low returns average out, so the portfolio is likely to earn an intermediate return more consistently than any of the assets it contains. Two kinds of risk. There's firm-specific risk, which affects only a single company. There's market risk, which affects all companies in the stock market. Diversification can eliminate firm-specific risk, but it cannot eliminate market risk. So here is an example where stock number of stocks is on the horizontal axis, standard deviation on the vertical axis. Standard deviation is a measure of risk. If it is coming down, that means risk is declining. And increasing the number of stocks reduces firm-specific risk. That is the benefit of diversification. But the market risk cannot be diversified away. Okay? Trade-off between risk and return. Riskier assets pay higher return on average to compensate for the extra risk of holding them. For example, over the past 200 years, average real return on stocks is 8%. Those are riskier assets. On short-term government bonds, or 3%. Government bonds are the safest assets out there. So the return on bonds are rather low. Suppose you are dividing your portfolio between two assets, a diversified group of risky stocks, average return 8%, standard deviation 20%. A safe asset, return is 3%, standard deviation is 0. The risk and return on the portfolio depends on the percentage of each asset class in the portfolio. Trade-off between risk and return is demonstrated in this graph. Return is measured on the vertical axis and standard deviation measured on the horizontal axis. And as you can see, increasing the share of stock in the portfolio increases the average return, but also risk. It varies directly, positively related. Asset valuation. When deciding whether to buy a company stock, you compare the price of the shares to the value of the company. Stocks are undervalued if the price is less than the value, overvalued if the price is greater than the value, and fairly valued if the price is equal to the value. Uh, Learning exercise 3. If you buy a share of AT&T stock today, you will be able to sell it in 3 years for $30. You will receive a dollar dividend at the end of each year. If the prevailing interest rate is 10%, what is the value of a share of AT&T today? Find the present value of the stream of dividends and that $30 at the end. So the first dividend comes in the first year. The present value is 91 cents. Second dividend the second year, the third dividend the third year. And then at the end of the third year, you sell the stock for $30. You find the present value of all those and you add it. So the value of a share of AT&T stock equals the sum of all this in red, and that is $25.03. Value of a share is equal to the present value of any dividends the stock will pay, plus the present value of price you get when you sell the share. The problem is when you buy the share, you don't know what future dividends or prices will be. So there are different ways to try to come up with the value. There's fundamental analysis, which is one way to value a stock. The study of a company's accounting statements and future prospects to determine its value. Efficient market hypothesis is another way to try to determine the value. Efficient market hypothesis, EMH, is a theory that each asset price reflects all publicly available information about the value of the asset. Three implications of the efficient market hypothesis. One, stock market is informationally efficient. Each stock price reflects all available information about the value of the stock. Two, stock prices follow a random walk. The stock price only changes in response to new information, which is news, about the company's value. News cannot be predicted, so stock price movements should be impossible to predict. Number three, it is impossible to systematically beat the market. By the time the news reaches you, mutual fund managers will have already acted on it. Index funds versus managed funds. An index fund is a mutual fund that buys all the stocks in a given stock index. An actively managed mutual fund aims to buy only the best stocks and have higher expenses than index funds. Efficient market hypothesis (EMH) implies that returns on actively managed funds should not consistently exceed the return on index funds. And that is proven here. If you take S&P 500 index funds, the annualized return was 6.2% and the expense ratio was 0.3%. If you compare that with managed uh, large cap funds, the annualized return was 5.9, less than 6.2%. And the expense ratio is higher. The other one is S&P Mid Cap 400 Index Funds. Annualized return was 10%. Expense ratio 0.35%. Compare it with managed mid cap funds. Okay, the annualized return is 8.1. The expense ratio is higher, 1.458. What about S&P Small Cap 600 Index Funds? Annualized return 12.5%, and expense ratio 0.55. Compare that to managed mid-cap fund, 10.3, and expense ratio 1.2. So it looked like buying index fund is a better deal than buying managed funds with high expenses. Market irrationality. Many believe that stock price movements are partly psychological. According to John Maynard Keynes, stock prices are driven by animal spirits. Those are waves of pessimism and optimism. There really is no rationality out there. Even Alan Greenspan in the 1990s mentioned that the stock boom of the 90s was a result of irrational exuberance. Bubbles occur when speculators buy overvalued assets, expecting prices to rise further. Possibility of speculative bubbles. Value of the stock to a stockholder depends on stream of dividend payments and final sale price. Debate frequency and importance of departures from rational pricing. Market irrationality. Movement in stock market is hard to explain. News that alter irrational valuation. Efficient market hypothesis. Impossible to know the correct rational valuation of the market. Conclusion. This chapter has introduced some of the basic tools people use when they make financial decisions. The efficient market hypothesis teaches that a stock price should reflect the company's expected future profitability. Fluctuations in the stock market have important macroeconomic implications, which we will study later in this course. Summary. Because savings can earn interest, a sum of money today is more valuable than the sum of money in the future. The present value of any future sum is the amount that would be needed today given prevailing interest rates to produce that future sum. Because of diminishing marginal utility, most people are risk averse. Risk averse people can reduce risk by buying insurance, diversifying their holdings, and choosing a portfolio with lower risk and lower return. The value of an asset equals the present value of the cash flows the owner will receive for a share of stock. These cash flows include the stream of dividends and the final sale price. According to the efficient markets hypothesis, financial markets process available information rationally, so a stock price always equals the best estimate of the value of the underlying business. Some economists question the efficient market hypothesis, however, and believe that irrational psychological factors also influence asset prices. And that would be all for this chapter.